Good morning from New York City. For our viewers worldwide, I'm Matt Miller in for Jonathan Ferro. Ahead of a risk-off session on this Monday, we have equity index futures extending losses on concern about high for longer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, traders bracing for a busy week of Fed speakers. The dollar hits its highest level since March as higher for longer fears continue to keep markets on edge. We begin with the big issue, and that is Treasury yields taking center stage once again. We saw a jump last week. Let's see what happens now.
Yields are rising.
The higher real yield story.
Why are bond yields rising?
So much of it's been driven by the recent stronger economic growth.
The economic growth in the third quarter has picked up.
Inflation indicators, whether you look at owner equivalent rents or oil prices, are starting to tick back to uncomfortable levels.
We're in an environment where the Fed is leaning towards potentially another hike.
Expectations for the next Fed rate cut have been pushed out into the future.
There's an acute awareness and concern on fiscal right now.
You've got a substantial amount of fiscal spending.
That's something that may actually even pressure Treasury yields modestly higher.
We're still not sure that we are at peak yet.
There's so much uncertainty on the path for Treasury yields.
Bond yields being higher, a Fed that's higher for longer is going to continuously put pressure on just the broader markets.
Joining us now, Morgan Stanley's Mike Zizas and George Goncalves from MUFG. Let me start by asking you, George, what you think about this new resurgence in yields. I mean, didn't we understand last week or in the past 2 years that the Fed was aiming for higher rates? And don't we know that they're going to hold it there until inflation is back down to 2%?
Look, the bond market's been skeptical, but I think they're finally starting to listen to the Fed. And this, to me, is not really, bond vigilantes really returning, but it's more about the bond bulls throwing in the towel. We've had a deeply inverted curve, a curve where, historically would be suggesting a recession is coming soon, which I still think that's the case. But nonetheless, while we're waiting, the bond market's respecting the Fed, and rates are normalizing from the belly of the curve. And we've been saying since really the midsummer that post-debt ceiling, we're going to have this supply deluge, and then the Fed staying on hold for longer. It was going to normalize the belly of the curve, and that's what hurts the most. It's the revenge of the bear steepener.
So I guess one concern, Michael, is that, inflation could be resurgent, and then the Fed has to continue, even hike again. How do you see prices coming under control?
Yeah, well, actually, we're pretty constructive on the idea that there's going to be a lot of pressures that push inflation lower into the fourth quarter. And it's not just some of the ones that are grabbing headlines, like the potential for a government shutdown to crimp demand or UAW strike. There's also just a natural give back that our economists have been flagging from consumption behavior over the summer around special events that isn't going to be there. And then on top of that, we've got student loan repayments starting again. We think you combine all of that, that's as much as taking down PCE by 1.3, 1.4%. Those other factors we talked about could easily drive GDP to a 0.1% quarter print. And we think there's a pretty meaningful risk of getting a negative payroll print. Now, none of this means there has to be a recession. We're still in the soft landing camp. Okay, but all of that suggests that what the Treasury market's pricing about the future Fed path might become a little more dovish after you start seeing some of this data. And that's the type of thing that should tell you that yield increases from here should be pretty limited. That should be pretty positive for bonds overall.
On the other hand, we have a wave of risks, I think, including the student debt repayments coming back online. Morgan Stanley's Mike Wilson sees consumer stocks losing their luster, writing, quote, "The technical breadth set up for consumer stocks looks particularly challenged. Price action is picking up on slowing consumer spend, student loan payments resuming, rising delinquencies in certain household cohorts, higher gas prices, and weakening data in the housing sector." George, this list goes on, and I think a lot of people have been repeating it over the past couple of weeks. What do you think about the headwinds for the U.S. consumer?
Look, I think that's a pretty comprehensive list, and I generally agree with what was said before. The problem is the Fed is keying off of lag data, and they're not minding their own lags of all these hikes that they put in place in a very quick and aggressive hiking cycle. The lags of all these hikes are going to hit on top of all those kind of economic headwinds. But as we heard from Chair Powell last week, forecasting the future is hard to do. So I think they're going to just wait until something breaks either in the economy or markets or both.
Maybe something breaks again, right? Because we've already had the problem with the banks. Let's get to, though, the data, because a lot is coming up this week. A lot of Fed speak, certainly, and some economic data. Bloomberg's Mike McKee joins us now for a preview. Michael?
Well, Matt, we could be talking about something that breaks, and that's the government. We'll talk about that in just a second. But we do have a busy week of data ahead, although not all of it is that important. Here's what really is going to matter, and I would point your eyes to Thursday when Jay Powell does a town hall with teachers. They don't get paid a lot of money, so I would imagine they will be questioning him about interest rates and inflation. Jobless claims may be that day. If the UAW strike distorts the numbers, they won't have a lot of information for the Fed and those who are thinking about trading on the Fed. Income and spending and PCE on Friday is the other big number because we get the Fed's favorite inflation numbers. They're expected to be better, but not a whole lot. And then Sunday, maybe data ends if the government shuts down. We have a lot of Fed speak as well this week. Kashkari, Bowman, Goolsbee, Cook, Barkin, and Williams all joining Jay Powell. We'll get an idea of how serious all of them are about raising rates one more time. They put it in their dot plot, but are they going to follow through? Whether they follow through may depend on the government shutdown, though. You put the calendar up for next week, and you see there's already a lot that we are not going to get information on. If the government shuts down, we won't get construction spending data, JOLTS, factory orders, the trade balance, jobless claims, and here's the big one, September payrolls. So I guess kind of the question for your guest, Matt, is if we don't get the payrolls report, how are Treasuries going to trade on that going forward? And then after that, the following week, CPI, if we don't get that.
Yeah, McKee, thank you very much for the suggestion. I'll put it to action right now from one Mike to the other. Mike Zizis, what do you think about the problem of a government shutdown? It seems like a very high likelihood that we see that. And, of course, we've got the strikes as well. So lack of data, lack of jobs. Does that concern you?
Yeah, it's concerning, right? And I think you have to take the government shutdown possibility very, very seriously at this point. And that's not a surprise. I mean, everyone in Washington, D.C. is basically saying the same thing. Look, I think on its own, a government shutdown is not a huge event for GDP growth, right? In our estimate, it's about 0.05 percentage points off of GDP growth every week. So you need a really long shutdown for it to matter. But because it's coming on top of the UAW strike, which if that goes full strength, all 146,000 employees are striking for a 5 to 6 week period, that could take another percentage point off of GDP that's not in our forecast. And on top of all the consumer stuff that we talked about earlier. So for us, it's not necessarily the data that's coming up in the short term. It's really kind of what the October data would show in November. And if you get all of those events together, we think the November data is going to be really, really weak, right? And again, that doesn't mean that there's necessarily.
But those things are inflationary.
It's still very much being the soft camping.
Isn't the strike especially inflationary, Mike? I mean, fewer cars. We're already down to like 35 days in terms of dealer supply. You know, before the pandemic, it was 75, which maybe was too much. But at the worst point in the pandemic, we were at 20, which is far too little. And that drove prices up, you know, dealers adding $5,000 to $10,000. If you get that, and then eventually you're going to get higher wages as well, how could you see inflation coming back to 2%?
Yeah, well, listen, I think we're talking about different time frames here, right? In the very short term, you're talking about foregone supply, but you're also talking about foregone income, and how those things come out in the wash over the long term is pretty unclear. But in the short term, if it's taking away from growth and the market's been set on expectations that the Fed isn't going to hike through the end of next year, we think the downdraft in data you see in the short term could reset some of those expectations closer to what our economists are seeing. And that would tell you that yields don't have that much room to go higher from here.
George, you have been right on in terms of your market calls. Rates jumping higher, we're seeing that again today. Dollar bid, we're seeing that again today. Risk off, we're seeing that again today. How much longer does this go, in your opinion, as the market kind of gets used to or starts to believe what the Fed is saying?
Look, we've had muddy waters all throughout this time period. And I think that what Mike just mentioned is just going to make it even more compounding and confusing into the next couple of weeks. But it does put you into that window where there's not much time for the Fed to kind of assess things before the November meeting. So I generally agree that we're probably closer to the end of this kind of rate sell-off. But you always have that kind of last kind of move where people throw in the towel. And I think that's what we're going through right now. And when that takes place, that usually hits risk assets. And I think that's also what we're seeing. Typically, a government shutdown or any sort of disruptions would be bullish for duration and for fixed income. But we live in an upside down world. I mean, I think, to kind of answer the other Mike's question, without data, maybe traders will trade better because we've had data where sometimes it gives you the opposite reaction. So I think, we'll take it one day at a time next week.
Yeah, we've had kind of a fire hose. It's had a fire hose effect. Mike Zizas and George Goncalves are going to stick with us for more. Right now, I want to get a look at the stocks that are moving ahead of the opening bell. For that, we go, of course, to Abigail Doolittle. Abby?
Well, Matt, let's take a look at some of the movers beneath the surface, because we do have futures modestly lower at this point, but starting out with one stock that's popping, CarMax. Shares are higher. This, of course, after Wedbush upgraded the used car retailer to outperform from neutral amid improving market share performance. Foot Locker, on the other hand, was cut by Jefferies, along with Urban Outfitters, not shown to a hold, with the analysts there saying that incremental consumer headwinds lie ahead. Urban Outfitters is down about the same amount. And then Netflix up about 0.4%. This, of course, on the tentative labor deal struck with the Writers Guild between some of the big studios, including Netflix. Investors are optimistic that it will become reality.
Yeah, so much strike news, but here we have what looks like resolution to at least one of those on the writers' front. Abigail, thanks very much for that. Coming up, a government shutdown showdown.
A lot of Republicans over the past week been frustrated by the handful of conservatives who blocked any movement. And so as that chorus might change, we may be able to see this potential change that we won't hit a government shutdown if they're willing to work with Democrats.
Conversation about that inevitability next. This is Bloomberg.
Looking historically at the shutdowns that have occurred, and there's been quite a few over the past number of years, in general, they do not have a major economic impact. The issue this time is that we're also now seeing, the auto strike that is occurring. We're seeing increasing pressures on consumers from student loan repayments, higher oil prices. If there is a shutdown, there's obviously a political price to be paid.
Speaker McCarthy and his allies spending the weekend working on a short-term government funding measure with just 5 days to go until a potential shutdown. Party infighting continues between McCarthy and other conservative hardliners, with key holdouts, including Representative Matt Gaetz, calling a brief shutdown necessary.
If, the Department of Labor and Education have to shut down for a few days as we get their appropriations in line, that's certainly not something that is optimal, but I think it's better than continuing on the current path we are to America's financial ruin. I'm not here to hold the government hostage. I'm here to hold Kevin McCarthy to his word.
Meanwhile, President Biden placing the blame solely on Republicans.
A government shutdown could impact everything from food safety to cancer research to Head Start programs for children. Funding the government is one of those basic responsibilities of Congress. And it's time for Republicans to start doing the job America elected them to do.
House GOP members expected to move forward on 4 appropriations bills this week, but it still leaves Congress set to miss the Saturday deadline. Bloomberg's Anne-Marie Horton joins us now. So, Anne-Marie, how inevitable is this?
Well, it does look like a shutdown at this moment is inevitable. What you're going to see tomorrow, a really key day. The Senate is working on their own version of the stopgap spending measure. And then you have the House coming back to session. And there's been a number of conversations over the weekend of what a new stopgap funding measure could look like. Could look potentially a higher cut in domestic spending from 9% to 27%. Also being weighed is that it actually could be longer, anywhere between 14 to even 60 days. And a debt commission potentially attached that to look at entitlement cuts. What Speaker McCarthy wants to do there, and I think a key phrase you heard from Representative Matt Gaetz, who continuously talks about a potential motion to vacate to get rid of the speaker is he says enough time to get these appropriations done. So tomorrow what you're going to see is Speaker McCarthy try to push through 4 appropriation bills. And these appropriation bills, whether it's defense, whether it's agriculture, homeland security, trying to really show some good faith with that part of his party to then potentially also get a stopgap funding measure, continuing resolution through to keep the government funded after Saturday evening. The issue, of course, is that what you're going to see come out from the Senate and the House is going to look widely different, which is why it does look like a shutdown, even if they are able to get their own measures passed through each chamber before Saturday. It does look like it's inevitable because they're going to have to come together and figure out what can pass in each house.
All right, Anne-Marie, thanks very much. Anne-Marie Horder in there covering the government shutdown, the potential government shutdown for us out of Washington. Mike Zizas and George Goncalves are still with us. And George, let me ask how much the market cares about this. I mean, I guess we all expect it to happen, right? But is it just sort of par for the course these days?
Look, I mean, we've been a market that rolled from topic to topic. We go from the Fed to other central banks. Now we're going to dealing with auction supply this week and as well as quarter end. But it is a critical event, obviously, if we go into a government shutdown. But I think there's partially a fatigue of what happened earlier in the year around the debt ceiling, that maybe the market's kind of taking this a little bit too sanguine. And if it does become like a longer shutdown as well as just nonstop continuing resolutions, that really will hamper growth for sure. So I think that the markets are kind of taking this one day at a time, as I said before, but I feel like it is going to be super critical as we get towards Friday.
Mike Zizas, what do you think? I mean, George made an interesting point that maybe we'd be better without the data in terms of the stock market. In terms of rates, I guess if the government shut down for too long, it's almost perverse, but people buy treasuries, right?
Well, yeah, because the implication is that it's going to dampen growth, right? So, I mean, to your initial question of do investors care about this, they do. It's got to be one of the most frequently asked questions we've been getting over the last 2 weeks. But I think the power here is less in a potential for a long shutdown crimping GDP, but rather in it calling attention to all the other data downdrafts that we've been talking about into the fourth quarter. All that together, and the shutdown is just sort of emblematic of it, would put pressure to at least limit yields rising further. And so we think investors are supposed to look at that and look at bonds more favorably instead of the way they've probably been looking at it over the past couple of months, which is, if I bought a bond, I lost some money on a total return basis. But over a 12-month basis, if you're buying them here, given the economic downdraft in the fourth quarter, we think you're going to be in a pretty good position to capture some really solid total returns.
It does seem like you should just back up the truck at these levels because even if you don't get the capital appreciation, which I assume you're expecting, you still get a decent return. What are the biggest risks, Mike, to your expectation of, I guess, soft landing and inflation coming back down to target? What are the biggest concerns for you?
Yeah, I mean, listen, obviously, if the fourth quarter data doesn't play out the way we think it would, then what's currently priced into the Fed's path is probably going to be pretty persistent, and that could push yields higher. Right now, for bond investors, that might mean some more short-term pain. But even if you think the Fed maybe isn't at the end of its hiking cycle yet, but will be within the next 12 months, and there's only perhaps a few more rate hikes on the table, we still think this is a pretty good entry point. You might have some short-term pain on a total return basis, but we think it's completely reasonable to expect high-grade corporate bonds, U.S. Treasuries, to kind of push close to double-digit total returns over the next 12 months.
George, what do you think? I mean, what's your outlook for 12 months from now, and what are the biggest risks to that?
Look, I mean, maybe we could zoom in on the next 12 days versus 12 months. Like, I think Mike is probably right on the medium term that we're trying to make a topping process here in rates. We just don't know if it goes any further. And this has been a very technical market, and it becomes illiquid very quickly. And so if we have this kind of gap higher, might be a great buying opportunity, but not many people will show up to buy the bond market, perhaps, if we have this big sell-off, because everyone's going to be scared after seeing what just took place. Meanwhile, you kind of look forward down the road, the rates should be heading lower given that sort of economic outlook that I think we both share here. But I do think that these technical factors, as well as the wild card around what happens overseas with if there's a need for foreign intervention, if selling of treasuries, that still kind of hangs over the market's head as well. So I do think that the risk is to one last kind of rise in rates, and then that really will start to crack the risk markets and then get money back into fixed income.
Mike, I know you're the head of fixed income research, but what do you think about the equity indexes here? We've had almost a correction in terms of the NASDAQ, is down 8%, let's say, since the end of July, beginning of August. The Russell 2000 is down more like 11%. It does seem like equity investors are a little worried.
Yeah, I mean, listen, you had a quote from my colleague Mike Wilson earlier, and I think that says it all, right? If you see the economy weakening, both in growth terms and in inflation terms, then that's not a great consumption backdrop. It's emblematic of not a great consumption backdrop. And in the market where the multiples expanded substantially, you should expect some give back. So it's one of the reasons that we've got more confidence in bonds delivering solid returns over the next 12 months. And we think it's going to be a tougher road for equities.
Mike, great to have you with us. Mike Zizas there talking to us from Morgan Stanley, where he's head of fixed income research, and George Goncalves from MUFG. Also great speaking with you. Thanks so much, gentlemen, for joining us. Coming up, the morning calls, and then later we're going to talk with Sarah Hunt of Alpine Sachs & Woods, joining us around the opening bell with her outlook for what assets do in this higher for longer environment. This is Bloomberg. Welcome back to Bloomberg The Open. I'm Matt Miller in for John Ferro. Let's get to the morning calls. First up, Jefferies downgrading Nike to a hold, pointing to slower consumer spending and macroeconomic headwinds out of China. China, really a big story today with, it looks like, another blow up, or I guess continued blow up in property. Next up, JP Morgan upgrading Dow to overweight, highlighting the stock's reasonable valuation and strong balance sheet. This is formerly Dow Chemical, now Dow Incorporated. Finally, Guggenheim upgrading Microsoft to neutral, saying that generative AI narrative is too positive a force to contend with. You can see Microsoft shares down in the pre-markets, not having much effect on that as the entire market seems a little bit risk off. You saw equity index futures, they are down. We see bond yields rising again. So there's a lot for the equity market to contend with today. Coming up, we're going to talk about that. Really, the main issue is the higher for longer, or high for longer, as some prefer to say, environment. Could mean good things for the energy sector. That's the view from Sarah Hunt of Alpine Sachs & Woods. That conversation next up at the opening bell. This is Bloomberg. It's got about 25 seconds to go until the start of trading on Wall Street. You can see that equity index futures are down, and the problem is investors are actually starting to believe the Federal Reserve when they say we're going to keep rates high for a fairly long amount of time. There you hear the opening bells. You can see the New York Stock Exchange here and the NASDAQ there. The NASDAQ, by the way, down about 11% since the end of July. So I think we're in solid correction territory for that index. Take a look at, the Russell 2000. The Russell 2000 down 11% since the end of July. The NASDAQ only down 8%. Let's switch up the boards and take a look at the Bloomberg Dollar Index, because I think that's one of the most interesting assets this morning. Right now at 1262, so the highest level we've seen since March, which feels like so long ago. The 10-year yield climbing ever higher, now at 452.73, approaching levels that we haven't seen again since 2007. NYMEX crude holding in that $90 range. West Texas Intermediate trading for $90.31, and we're seeing Brent still maintaining a level under $95 a barrel, but very close to that. And that's a concern, I think, for the equity market. One stock to watch, speaking of equities, at the open is Warner Brothers. Film and entertainment stocks have gotten a boost as striking screenwriters reach a tentative new labor agreement with Hollywood studios, including Disney and Netflix. Bloomberg's Abigail Doolittle joins us for more with what the end of the strike could mean for these stocks. Abby?
Indeed, Matt. We do have a potential resolution here to this very bitter months-long strike with Hollywood. The Writers Guild of America, representing more than 11,000 screenwriters, on Sunday night, last night, said that they had reached a tentative deal on a new contract with some of those big entertainment companies. It's interesting to see them a little bit mixed right now, suggesting that investors are maybe they want more, which we'll be talking about in a moment. But in the coming days, even as soon as tomorrow, we could have a vote with the Guild members voting on whether to accept the deal. They basically got much of what they wanted, had demanded, including increases in compensation for streaming content, concessions from studios on minimum staffing on some of the television shows. The Writers Guild, their committee, their comments really bubbling, saying this deal is exceptional. On the other hand, the entertainment studios basically acknowledging that a tentative deal has been struck. Apparently, language around AI is the one sticking point. But I think the reason that we don't have these stocks really flying higher, Netflix is up more than 1%. SAG is still on strike, of course. This is hopeful that maybe the actors will also find some kind of a deal. But right now, if this deal for the Writers Guild is in fact struck, it means only the late night shows will be restarting because they don't have actors. So stay tuned, but some optimism here that, again, this bitter feud in Hollywood, that maybe it's coming to an end.
All right, so could see the potential end of one or even two strikes. Abigail, thanks very much for that. Abigail Doolittle looking at the reaction in those stocks. Let's turn to tech, though, right now. Big story on Amazon today. It's going to spend as much as $4 billion to buy a minority stake in generative AI startup Anthropic. The CEO, Andy Jassy, writing, quote, "We have tremendous respect for Anthropic's team and believe we can help improve customer experiences through our deeper collaboration. The idea is Anthropic would use Amazon's cloud services and chips." And, of course, Amazon already promotes this business. Bloomberg's Ed Ludlow joining us now from San Francisco with more on this. I think partnership is probably a good word, Ed.
Yeah, it's interesting to understand the mechanics of it. As you said, Anthropic will migrate its software into the AWS cloud, but also make use of Amazon's proprietary silicon, the AI accelerator Trainium on the training side and the AI accelerator Inferentia on the inference side to build its next generation of large language models. 4 billion up to 4 billion. I think what I'm hearing in the first instance is it's more like 1.25 billion, and we go from there upwards. On the semiconductor side, it's interesting because it is a vote of confidence in AWS's proprietary silicon. We've talked so much about NVIDIA and the H100 AI accelerator as being the kind of benchmark for compute in the building of large language models. But the other way of looking at it is this just Amazon paying an AI startup to use its chips, kind of a reverse revenue situation, which I also find interesting. Claude, which is Anthropic's foundation model, was already available on Bedrock. And Bedrock is basically Amazon's open source platform where third parties can either build their own large language models or use the template for those that already exist. And later on in the show on Bloomberg Technology, AWS CEO Adam Selipsky will be on the program. And there are a number of questions to ask about why Amazon did this. You know, they've been flexing a lot their own competence in the field of generative AI and also building of foundation models, but they're making a sizable investment here. One quick point, Matt, Google is already an investor in Anthropic and also holds a minority stake. So there's an element of competition and frenemies here, which I quite like.
Well, first of all, I love the name Claude. That's fantastic. Did you say you're going to have who's going to be on your program? AWS boss?
Yeah, the AWS CEO, Adam Selipsky, is going to be on the program later today. And I just have so many questions about how this is going to work in practice. Like, why use someone else's technology versus build your own? You know, Amazon usually does it on its own. But if they go the full 9 yards and do invest $4 billion here, raises the question why they didn't just buy Anthropic outright earlier in the year when it was at a much lower valuation.
Yeah, fascinating. I'll be tuned in to watch that for sure. I mean, AWS, obviously the biggest cloud operator in the world. Plus, as you point out, they make their own chips, and typically they do all of their own work. So this investment is a really interesting deal. Adam Selipsky joins Ed Ludlow and Caroline Hyde at noon today or thereabouts. Definitely tune into Bloomberg Tech for that. Now, from new tech to old, let's talk about HP. Remember Hewlett-Packard? Those shares under pressure as billionaire investor Warren Buffett continues trimming his stake in the computer and printer maker, selling 129 million shares according to the latest SEC filing. Bloomberg's Katie Greifeld joins us now with more on HP. Katie?
Hey, Matt. Yeah, Berkshire Hathaway unloading HP shares yet again this month. Shares currently flip-flopping at the moment, slightly higher right now. They were down as much as 4% in the pre-market after Berkshire to close in a filing that share sale. And that sale took place over 3 transactions between the 20th and the 22nd. And it follows Berkshire's earlier sale of about 160 million shares just a week or two ago. Now, rewind. Remember that Berkshire began building up this stake in the PC maker last spring. And looking at the filings, it looks like Berkshire may be rethinking that position now. And remember, we got HP's latest round of earnings late last month. Revenue dropped by nearly 10%. That ties back to China. And HP also lowered its full year profit forecast. So you add it all together, it's been a painful stretch for HP. Of course, it's still about unchanged on the year, maybe down about 1% or so, but shares have fallen more than 20% since just mid-July, Matt.
All right, Katie, thanks very much for that. Katie Greifeld looking at HPQ for us. Let's turn back to now the higher for longer narrative. Sarah Hunt of Alpine Saxon Woods weighing in on the market impact, writing, quote, just as all have settled in for a nice soft landing, it looks like some of the tailwinds may be ebbing. The market is starting to absorb the higher for longer message that, to be fair, the Fed has been singing all along. And that realization is not going gently for equities. Sarah, I'm pleased to say, joins us now on a day when it looks like we're going to see more equity index drops. The NASDAQ, as I mentioned earlier, is about 8% off the highs we saw in July. The Russell 2000 is down 11% from the end of July. So it's weird, Sarah, that we're talking about, and everyone seems to agree that a soft landing is coming, but we're getting these recession warnings from the stock market. What's up?
Well, you've got a combination of factors going on, right? I mean, first of all, we were going to have a big recession. It was going to happen early this year. Then it was going to be shifted to the second half of this year. Then it wasn't going to be a recession at all, but the Fed got everything just right, and it was going to be a soft landing. I think it keeps evolving as we keep seeing events overtake what the themes are in the marketplace. And I think right now, I mean, higher for longer, when you really are just going back to 2007 levels, as you mentioned earlier, the recency bias that we all have for low interest rates, we should be reminded that that's not the norm, historically speaking. So I think that there's really a catch-up that has to happen here because bonds have been looking at one thing and equities have been looking at another, and they haven't really been aligned.
Is the Fed guilty of, leaning on this recency bias? I noticed that on Wednesday they said rates are going to get back down to 3.9% by the end of 25, 2.9% by the end of 26. Now, I realize forecasting that far away from an organization that has a pretty poor record of forecasting isn't so key, but why do we feel the need to push rates down? I mean, the average over the past 50 years has to be closer to 5, right?
The average is closer to 5, but you have to look at how indebted governments are, right? So if you're looking out further than that and you start to see that all the governments that now have to pay those rates on government debt, it starts to become a scarier proposition. So I think part of it is, maybe we could survive at a lower rate than 5%, but I think that the zero bound and the negative numbers that we had post the financial crisis just had driven a lot of odd things to happen, and getting back to normal is not necessarily a smooth path.
Well, last week, all the bears seemed to capitulate, or the final bears. And at the same time, we're looking at a UAW strike that could stretch, right, expand and stretch, a government shutdown that seems pretty much inevitable, and a consumer that at least, if it's stronger than it was pre-pandemic, it at least is weakening, right? With less savings and more bills coming due.
Absolutely. And I think the problem is that once you finally get to the point where the market was just going up and people were expecting it to go down. So people finally capitulate and go, okay, maybe it's not going to go down so much. And then you really start seeing these tailwinds that are somewhat the long and variable lags that we've all been discussing ad infinitum since the beginning of the year. And I think that there is some real concern about weakness in the consumer. All of the things you just mentioned, higher oil prices take a bite out of everything. That number of how much more households have to spend every month is not a small number. And even if inflation comes down because of base effects, it doesn't mean that that number gets smaller immediately. And I think that there's a real spending issue coming up, and I think that that's going to impact earnings. And I think that's where we are a little bit more cautious and think that a 12%, which is consensus for the S&P next year, seems a little high to us.
Earnings, I guess, you know, one of the things I was hearing over the weekend, Sarah, is that now earnings maybe are more important than the Fed. And I guess it could be bulls that are looking for something, right, in the face of what could be another hike and 2 fewer cuts. What's your outlook for earnings? How do you see that argument?
Well, I think it's difficult because you had this big push in inflation, right? And if that was good for earnings because top line revenues grew while margins were still strong, I don't understand how inflation coming down is not supposed to be bad for earnings. And I think that we've had this idea that somehow we can just continue to grow from where we are, and I think that's very difficult, especially if we do get some reduction in inflation. You're seeing costs go up across the board. Labor costs are going up. I mean, that's part of this whole discussion that's going on with the UAW and in Hollywood and everywhere else, and you've got higher energy and food prices. So it's hard to see how margins don't and input costs don't start to squeeze margins. So I think that makes earnings, especially the idea that they're going to grow above 10% next year, is a little trickier for us to get our hands around.
So what do you do right now? Do you buy defensive stocks? Do you buy rates? Do you start moving out the curve? What do you do if you're worried?
I think that you have to look for businesses that are going to grow, hopefully, in any environment. And you have to look at we're talking about some big thematic stuff. Like there will be an energy transition. It will take a lot longer than everybody is expecting it to. But in the interim, I think liquefied natural gas, I think the stocks that play into that, I think that they've got a good runway going forward. Energy stocks are higher, but not nearly as high as the oil price right now, because people don't believe that oil prices are going to stay up here. And they may fluctuate from here, but I think you've got a longer tail investment that people are willing to look through because they're expecting a transition much quicker. We also like companies with really good balance sheets. Some of the defense stocks, I mean, speaking of defensives, have really been getting hit very hard as we had this huge push in growth stocks that pretty much obscured anybody else in the market over the last year. So I think that there are good places and there are good balance sheets, but you have to be looking at the valuation, which for a while we haven't had to do. And you also have to be thinking about what does the world look like over the next 3 to 5 years, and where is investment going to go? Because that's ultimately where you want to be investing.
Sarah, great to get some time with you. Thanks so much for joining us. Sarah Hunt there, coming to us from Alpine Saxon Woods, where she is chief market strategist. Coming up, President Biden heads to Detroit.
All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike.
Our team coverage up next. This is Bloomberg.
We can and will go all out if our national leadership decides the companies aren't willing to move. Stellantis and GM in particular are going to need some serious pushing. All of the parts distribution facilities at General Motors and Stellantis are being called to stand up and strike. We will be striking 38 locations across 20 states, across all 9 regions of the UAW.
That was UAW President Shawn Fain calling for an expanded strike, with General Motors and Stellantis facing walkouts at 38 more facilities after talks last week failed. President Biden heading to Michigan on Tuesday to join the picket line ahead of Donald Trump visiting on Wednesday in lieu of a GOP debate. He's going to skip that one again, too. The White House insisting on the possibility of a win-win deal.
He is proud of being the most pro-union, pro-worker president, not only compared to the Trump administration with its anti-union policies, but really compared to any modern president. You're not going to find somebody who has more consistently stood with unions. Now, having said that, it's also the case that these auto companies can thrive in a win-win deal that does what the president has called for, which is to say that record profits should lead to record pay and record benefits for the workers who are creating all that value.
Let's get to our team coverage now. Bloomberg's Kayleigh Lines in Washington, D.C., and David Welch, our bureau chief out of Detroit, joining us to talk about this. Kayleigh, first off, I think interesting, maybe surprising, exciting. The president is going to go and join, what, the picket line? He's going to stand with the unions in D.C.? I mean, this is going to be, invigorating, I guess.
Theoretically, Matt, it could be. This would really be likely the first time any president in U.S. history has gone to join striking workers at the picket line. But that is exactly what President Biden is planning to do tomorrow. He has accepted the invitation of Sean Fain, the UAW president, because remember, Matt, in making the announcement of the expansion of the strike on Friday, he said, "We welcome anyone who supports our cause to join us at the picket line, President of the United States included." So, yes, you are going to see President Biden there tomorrow. But, of course, that front runs by just one day the planned address to UAW workers from Detroit of former President Donald Trump. He will be counter-programming the second Republican primary debate on Wednesday evening, addressing the union. Both of these men really competing for the auto workers as voters and wanting their endorsement because, of course, the UAW has yet to endorse former President Biden or any other candidate for that matter in the 2024 race. Now, we understand that former President Trump is going to make a lot of his remarks about the transition to EVs, the idea that this could outsource jobs for China, for example, try to fire up union workers on that front. The EV push, of course, something that President Biden has pushed for very heavily, but he also has dubbed himself, as we just heard Secretary Buttigieg say, as the most pro-union president in U.S. history, and he is going to try to prove that tomorrow as he joins these workers on strike. Right.
And he wants the EV infrastructure to be here in America. That was pretty clear from the IRA. Let's get over to David Welch right now. And my question, David, is could there be a win-win? Because the unions, although they accepted a deal to help the companies survive post-financial crisis, they kind of put those companies in ruin with the previous deal into the financial crisis. So, could there be a win-win, or are they going to drive costs up so much that these companies aren't going to be able to make any margin?
It depends on how much. Now, first of all, labor's like 5 to 7% of the cost of a vehicle. So even if they got a 20% pay raise, that's 1% on total costs. So look, this isn't debilitating what the union wants, unless they get pensions and they get retiree health care. And it doesn't look like they will. Sean Fain hasn't talked about that in his last few addresses. He's talked more about cost of living allowances, raises, job security. So there is a way, and I think it's how it is shaping up. If you look at what Ford has agreed to so far with the union, there is a way that the workers will get very nice raise, better benefits, and it will definitely drive up costs. There's no question about that. But the companies can still remain very profitable. They'll be a high-cost producer compared to their competitors, but they will be very profitable.
What is the likelihood, David, and I've been thinking about this all weekend, that these unions for GM, Ford, and Stellantis get a great deal, and it's strong enough to bring in workers that are building Hondas or BMWs or Teslas that aren't in a union?
That's the union's goal. They want to be able to, basically show up, a big victory flag here to those workers, particularly Tesla, but all of them. The problem is the union's never been good. They've never succeeded at organizing Japanese, Korean-owned plants, even German-owned plants. Has been mostly failure for them, and they made very little headway with Tesla. So they're going to need a very good contract to do it, and they're going to have to do a much better, much different kind of sales job than they have in the past.
This is one of the things that President Biden has said, Kayleigh, that unions bring up wages for all Americans, even those not in unions. This is a chance also for President Biden to show that he's energetic, to show that he, has vitality. Is he going to be able to do that?
Well, certainly he'll try because, of course, this isn't just the current U.S. president. This is someone who is seeking to be president again, running for re-election in 2024 and trying to be out there on the campaign trail, visiting all these different states as he tries to tout Bidenomics, the resurrection of the American manufacturing economy that he is trying to bring about. And, yes, the rise of U.S. labor as a force within the wider U.S. economy. So he is going to try to do that, Matt. We'll all have to wait and see how things actually turn out tomorrow.
Kayleigh Lyons and David Welch, thanks very much for that. Coming up, the market-moving events you need to be watching next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Matt Miller in for Jonathan Ferro. Take a look at some of the moves we're seeing across assets. Bloomberg U.S. Dollar Index, the strongest level we've seen since March, so it's climbing higher. If you look at rates, we have the 10-year yield at the highest level that we've seen since 2007, making new highs there. And, of course, equity indexes are trading lower on concern about that higher for longer March. Time now for the trading diary, what you need to be watching this week. Minneapolis Fed President Neil Kashkari speaking at 6 p.m. Eastern. Tuesday, tomorrow, President Biden, as we said, heading to Michigan to join the UAW picket line. Fed speak picks up on Thursday with Chair Powell, Goolsbee, Cook, and Barkin. Plus, we'll get another U.S. GDP and a round of jobless claims. And finally, the government shutdown deadline coming at midnight on September 30th. This was the countdown to the open. This is Bloomberg.